Hello and a warm welcome to Econoday Unplugged and a monthly roundup of what's going on in the global economy and financial markets. It's Tuesday, 24th of May, 2022. And on the podcast today, we have Terry Sheehan on US East Coast, Max Sato in British Columbia, Brian Jackson in Sydney, and I'm Jeremy Hawkins in London. Well, if you're a policymaker or an investor, you know you have real problems when bonds and equities start falling at the same time. And amidst all the recent volatility in financial markets, that's what's happened so far this year. Not only is high inflation and the subsequent tightening of monetary policy bad for bonds, but by squeezing real incomes and undermining confidence, it's also exacerbating the slowdown in the global economy. And that's bad for equities, especially when the so-called Fed put no longer seems to be an option. So if falling asset prices driving down wealth and providing another hit to demand, increasingly it seems that either inflation is brought back under control or recession might just prove unavoidable. Indeed, according to this month's Bank of America Global Fund Managers Survey, such is the uncertainty about where to invest now that cash has been accumulated to levels not seen since the aftermath of 9/11. Little wonder then that ahead of this week's World Economic Forum in Davos, the IMF chief warned that the global economy might be facing its biggest test since the Second World War. So let's have a look at how Econday's regional experts see local economies shaping up over the rest of the year. Terry, if we kick off with you then, inflation still the dominant theme. So with what? Passive quantitative tightening due to begin next week, another 50 basis point hike in rates widely expected in June. Is the Fed on course to get inflation back under control, or does the economy need to slow significantly further first, do you think?
I think the Fed is finally beginning to catch up on inflation. One thing we have definitely seen in the recent economic data is a fairly rapid cooling in our housing market, which was one of the big sources of upward price pressures for housing. So higher interest rates are definitely having an impact on demand there. There's also some anecdotal evidence that consumers are indeed pulling back from some spending elsewhere. And the other thing facing US households is that gasoline prices are once more at record highs. So we're probably going to see even weaker consumer confidence for the month of May, and really just have an overall sense of concern about the outlook that's going to keep the consumer in check.
Okay, let's stick with the consumer for the moment. Target and Walmart suffered their worst trading days since 1987, they reported last week. And do you think consumers have really simply just stopped buying sofas and TVs, so perhaps symptomatic of a general cutback, or do you think there's some kind of shifting purchasing preferences going on, towards services or whatever it may be?
I think part of it is that, in many cases, the goods that US consumers want are just not as available they were.
Mm-hmm.
And people are waiting until they can get the particular model or unit that they want. Just again, anecdotally, from my point of view, it's really kind of surprising to go into a US department store or one of the big box, what we call big box stores, and just see that there are shortages of goods, and we're just not used to that.
You're right. I mean, I guess it's pretty well true of all of us at the moment, the various regions we cover, that it's so difficult when you're looking at the data in many ways to determine, how much of it is a supply side issue and how much is due to, the fact that demand's slowing. In terms of the output side, we can ask you about weekly jobless claims. I know people get very excited about weekly numbers, your side of the pond, perhaps more so than most other parts of the world. I mean, they've been drifting up now pretty well since the middle of March, I guess. Is that indicative, do you think, of a slowdown in economic activity, or again, is there something else going on?
I think if you look at the level of jobless claims, the underlying level seems to be around 200,000 a week, which in historic terms for the US is still consistent with a very tight labor market. So I think this drifting up is not necessarily a bad development, but it's still a very tight labor market by all measures here. The insured rate of unemployment, which is the rate for people who are eligible for unemployment benefits, actually was 0.9%, its historic low last week. So definitely, we still have a very tight labor market in the US.
Yeah, and I guess that's probably true for most of the rest of us as well. Okay, so you say that perhaps the US economy is still doing pretty well. I know you look at these nowcasts coming out of the various Fed regions and so on. What's the kind of expectation for second quarter GDP at the moment?
Well, it's very early days, and there's a lot of data to come out yet before. But it looks like it's running around 2%, which for the second quarter, which just isn't all that bad. And if we are past the peak of upward pressures for inflation, which the last month or so's worth of data has hinted at, we need a couple more months before we really know that's true. It looks like the combination of Fed policy and other factors are having the effect wanted, although it's going to be a while before inflation gets back anywhere near the Fed's 2% target.
Right. Let me ask you, in the intro, I mentioned about this, this so-called Fed put, and essentially where investors believe that the Fed will only allow the stock market to go down so far. Do you think we're in a mode now, particularly hearing what Jay Powell said in recent days, if not recent weeks, whereby the Fed is that much more willing to tolerate a weaker equity market with a view to try and ensure that demand doesn't grow too, or doesn't continue to grow too quickly, and hence maintain upward pressure on prices?
I think Jay Powell, by the way, who has now been confirmed and sworn in for his second term as Fed chair, I think he's taking a very hard-nosed view, and I think markets should believe him.
Fair enough. Okay, let's round off in terms of these questions from me. Outlook for interest rates. And I mentioned, I assume it's 50 basis points nailed on for June. What about beyond that? Or do you think it could be something different, perhaps even more than 50 basis points next month?
It's highly unlikely it will be more than 50 basis points. At his last press briefing, Powell specifically said 75 basis points was not on the table. On the other hand, he gave us sort of non-guiding Fed forward guidance in terms of saying that for the next 30, 60, 90 days, that it really was, the outlook was so uncertain that providing any sort of monetary policy guidance was just difficult. So they weren't, he wasn't going to, he did not want markets to interpret anything he said as a hard promise. 50 basis points at the next meeting, very likely. 50 basis points at the meeting after that, highly likely. But after that, we just have to see what the economic data has been doing.
Okay, fair enough. Anything else from your side, Terry?
No, as you said at the beginning, right now it seems to be mostly inflation.
Watch this space then. Right, great. Thanks for that, Terry. Okay, let's go across the border then. Mr. Sato, where are we? Bank of Canada in their last report expected inflation in the second quarter to be 5.8% year on year, if I remember rightly. Now, we're already running at 6.8%. The core rate's up at 4.2% on the basis of the average of the Bank of Canada's numbers. Is there anything to stop the Bank of Canada increasing interest rates again in June?
I think both in Canada and the US, central banks are a little bit behind the game. So there's nothing really to stop them from raising rates right now. And of course, people would like to talk about the risk of stagflation, but I think I would be hesitant to call it a 50 basis point oversized increase, because in an emergency at the beginning of the pandemic, they cut by 50 basis points 3 times in a row in just within the same month. That was March 2020. Right. So if you just rewind that much, I wouldn't call it a huge increase. And if you believe what Bank of Canada policymakers are saying, Canadians on average saved enough during the pandemic, and there's still some pent-up demand. Of course, food and gas prices are killing us, but in the near term, I don't think there's anything to stop them from raising rates at the moment.
Right. Let me, as always, try and play devil's advocate then. The Conference Board of Canada said last Friday consumer confidence decreased by almost 12 points in May. That's its largest monthly drop since the pandemic started. So, other signs now coming through that even just the relatively limited increases we've seen in rates out of the Bank of Canada so far is starting to impact the consumer sector, or do you think they really have to do a lot more to have an impact?
I think it depends on where you stand, whether you are hotel managers or retailers or service providers. There may be a shift from spending on goods to services. But generally, the forecast for the upcoming retail sales are pretty bullish. So
right.
Yes, and in anecdotal evidence, you see some empty shops and business closing down. But I think in hard data, we'll get to see some more solid numbers at the moment.
Okay, and if I just ask you about the housing market, because it seemed, just looking from my side, there's been some slightly mixed numbers coming out on that. And we saw a big number for April housing starts, over 267,000 at an annualized rate. But existing home sales fell very sharply, down up just over 12%. And activity rates there are down over 21% year on year. So you got any idea what's happening to the housing market? Because clearly it's been a major issue for the Bank of Canada for a long time. Do you think it's the case now it's actually starting to cool, or is it really still just motoring along?
I think we're coming down from a very high level, especially in Ontario and BC, British Columbia, and big cities like Greater Toronto and Vancouver, and even in Victoria here. So even though we're going to see a slowdown, you have to keep in mind that there's still a real estate bubble here, and we're coming down from a very high level.
Right, I guess that's true for so many countries as well, housing markets general. Right, anything else you'd like to chip into the pot from Canada?
We have the Bank of Canada policy announcement on June 1st, and not directly related, but we have the Ontario parliamentary election on June 2nd. Conservative Party is leading by big margins, so I don't think there's going to be any change to COVID policy or business policy.
Okay, fair enough. Well, thanks for that, Max. But before we let you go, let's move down to Asia and specifically Japan. We've had negative first quarter growth, but inflation, like in so many other countries around the world at the moment, I think you've got about a 7-year high on the core rate, something like that. So BOJ policy, is it ever going to change?
No.
Good answer. That's what we like.
I might have discussed it before, but while Kuroda is in office, that's until next April, there's no way they can make a huge change to their policy stance without either rewriting the joint declaration with the government dating back to January 2013, or BOJ could still make a lot of excuses and say we have to make a little bit of an adjustment to the yield curve control framework. But as Kuroda has said clearly, they will continue to bring inflation to around 2% in the longer term. This means stabilize it, anchor it, instead of just seeing temporary pop this year and declining to 1% next year. So in the bigger picture, I don't think there's any policy change until next year, and even in the next fiscal year, unless somebody really brave in government at the time to rewrite the joint statement between the government and the BOJ and change the 2% target, inflation target, or do something really drastic. I don't see anything coming up right now.
Okay, fair enough. And also, I know this is another issue we talked about on previous podcasts, but probably need to ask you about the exchange rate. A couple of weeks ago, we had the finance minister Suzuki suggesting that, well, to quote him, we are closely monitoring foreign exchange movements with a sense of urgency. And as dollar yen was trading, round about the 130 level, and clearly we've had it trading above that. Do you think we're getting to the stage, and I know dollar yen has actually pulled back, and that's partly, I think, because I had a bit of a bounce in the euro, dragging the dollar down today, but putting that on one side, do you think, much above 130 on dollar yen, the BOJ is that much more likely to come out and express the fact that it's not happy with, I guess, what it would call the instability of foreign exchange markets?
Okay, there are two issues here. One is for the government and the other for the Bank of Japan. First, the finance ministry, they're the one to decide where to intervene, when, with whom. But it's really up to the coordination between the U.S. and Japan too. And if you're talking about dollar yen, and instead of the usual recent pattern of stopping the yen from gaining further, they could use basically an unlimited amount of yen they can print. But in order to stop the dollar from rising further, they have to use a limited amount of their foreign reserves. So even Mr. Yen Sakakibara said he was a little bit scared looking at the what they had left in the foreign reserves. So that's one a challenge. And the other thing is, I don't think the U.S. Treasury wants to see the dollar falling in one way, in a one-sided way drastically, because that could push up the American import costs. So these are the reasons I don't see immediate coordinated U.S.-Japan forex intervention. And the issue with the Bank of Japan is even during this period of nervous trading about 130 yen to the dollar, Kuroda said overall he still believes the depreciation of the yen is net positive for the Japanese economy. That's probably because big exporters can bring in dollars and make a profit out of the earnings overseas, even though that doesn't mean they're going to raise wages. So also the bank's policies closely linked to keeping the yen weak, generally weak, by injecting cash into the system. So unless they change the overall monetary policy, they're not going to intervene at this point in time.
Okay, fair enough. I must say it's going to be interesting watching what happens to dollar yen, since it seems if all the other central banks now at least gradually moving towards the idea of raising interest rates. Clearly, a lot of them have already. Particularly if we do see the Fed tightening aggressively, what it's going to mean for the dollar yen exchange rate. Anything else from your side then on Japan, Max?
Yes. I thought even though GDP contracted, it was smaller than expected, the negative figure. And also, I think there's some resilience in the economy. Consumption didn't fall as much as I thought, or everybody thought. It was basically flat instead of a plunging. And that's probably because there were COVID restrictions, but Japanese always sort of live with the pandemic, and wearing a mask and maybe keeping some distance. It's probably impossible to keep a lot of distance in Japan, but did go eat at restaurants, did some traveling, but now that's into the second quarter opening up. So I think the rebound in April, June may be bigger than we now forecast. The other thing is on the trade front, exports in the latest figure from April still continued rising, and then that's the second highest after hitting the record high in March. The only thing about weakness in imports is Chinese lockdown and they couldn't bring, for example, smartphones and clothing in. That's it.
Okay, thanks for that, Max. Interesting stuff. Right, well, let's move to Brian then. I guess very much a key focus of all financial market players at the moment is China. So, lob a couple of numbers in to start with. Retail sales growth in April down 11.5%. That's its weakest since March 2020. Industrial production down almost 3%, first fall since March 2020. And a third number, unemployment rate up at 6.1%, the highest since the pandemic peak in February 2020. So, Brian, what's going on? Just how much damage do you think these lockdowns in China are actually doing to the domestic economy?
I mean, that's clearly the number one factor. I mean, if you lock down a city the size of Shanghai as severely and as prolonged as they have, you're going to see those that impact in the economic data. And of course, we've also had similar lockdowns in other major industrial and trading cities like Shenzhen, Beijing, right across the country. So. I don't think we should be surprised about these weak numbers, and obviously the Chinese authorities have made the call that it's worth putting up with that economic pain to try and get a hold of COVID, which is still obviously a major concern for them. On the flip side, it obviously though suggests that we will see a pretty strong bounce back if and when we do get through this zero COVID strategy that Beijing has been persisting with.
Okay, let me ask you about interest rate policy then. I mean, clearly there's been a lot of talk about, because the way economic activity has been slowing out there due to these lockdowns and whatever else it may be, there's a good chance that we'll see lower interest rates coming through. So 5-year loan prime rate, lowered last Friday. By whatever it was, 15 basis points, remember rightly. But right. The 1-year loan prime rate is still where it was at 3.7%. So, I mean, does this kind of intimate that monetary policy is being specifically directed at certain areas of the economy? So they're worried perhaps about a housing collapse, but they're not quite so worried about the rest of the economy, or what do you think is going on?
Yeah, I think they're obviously trying to fine-tune policy, based on the view that hopefully this won't be a long-term persistent strategy that they have to do with the zero COVID policy. So they're obviously hoping that they'll be able to get back to normal with the rest of the economy, and so they don't want to be too aggressive with monetary policy, particularly when everyone else around the world is moving in the other direction. And so they're trying to just limit how much they do and really try and target it specifically as much as they can too. So it's always hard to fine tune an instrument like monetary policy perfectly, but I think the idea behind the decision to leave the 1 year unchanged but lower the 5-year was to provide specific assistance to the housing market, with mortgage rates. We've had house price growth slow for about a year now consecutively. So I think that was the main thinking behind that call.
Okay, fair enough. I've got to ask you about just in general in terms of COVID and these lockdowns. I think the last thing I read was they're hoping, was it for Shanghai to reopen, at least in broad terms anyway, was it the 1st of June? Is that still the case? And where do we sort of stand on COVID in China now?
That's the latest I've seen. They have started to relax some of the restrictions. I saw some reports over the weekend that the port in Shanghai is back running sort of around 80 or 90% capacity. So that's a positive sign. There's still outbreaks in certain parts of the city, and so there's still some concern. But at the moment they're hoping. So that's next week that they will be able to relax a lot of those restrictions. And so as I said before, that's obviously the hope is that we'll see a big bounce back in economic activity. But you might not see it until sort of the July, August numbers come out later on the year.
Right, and I've got to ask you, I mean, in terms of this, was it 5.5%? I think the government's target, isn't it, for GDP this year? Yeah. Is that still seen as being remotely plausible, or have recent developments made that pretty well unattainable, do you think?
I wouldn't rule it out. As I said, if there's this huge bounce back, you would think there'd be a lot of pent up demand, a lot of capacity to spring back pretty quickly. But it's I guess whether it turns out to be 5.5, or somewhere around there, that's not the main issue. The main issue is just trying to get things back to normal. So I don't think they're absolutely wedded to that 5.5% goal. That's something that they'd like to get, but the main thing is just trying to, and that they do have a ready-made excuse, obviously, if they don't hit that target, given what we have seen over the last 2 or 3 months of all the lockdowns.
Okay, fair enough. Right, let's shift across to so contrast. The People's Bank of China clearly looking to ease policy at the moment. South Korea, central bank there. We got an interest rate meeting coming up this week, tomorrow, if I remember rightly.
Yes.
Are they expected to raise rates again?
Yeah, I think the consensus is 25. Some talk maybe they'll be a bit more aggressive. So 50 I think wouldn't be off the table, but 25 I think is the more likely outcome. But yeah, they're they were the ones to first get the tightening cycle going here in the Asia Pacific region. I think it was as far back as October, and they've been pretty steady since then. I think they had one meeting where they left rates on hold, but have been going every other meeting. So I don't expect that to end anytime soon. They're clearly in a tightening cycle. Inflation is clearly above where they want it to be. The activity numbers have been pretty solid. So yeah, I think it's a classic case of we've got to try and get policy back to pre-pandemic levels, and we're going to do it sort of bit by bit.
And are there any concerns about what's happening on the export side? It seems looking across a fair chunk of Asia at the moment, due to various factors, exports by and large, particularly those countries which are largely export dependent, they seem to be drifting lower now. Is there any concern that that's going to start impacting growth at some point this year, or is it too little a decline to have any major impact upon what's happening to growth?
Oh no, it will. It will definitely be noticeable. But I think again we have a ready-made reason why trade flows have been impacted, and that's obviously what's going on in China. And so from a policy perspective, I think they're trying to look through that impact, which they hope will not be a very long-lasting impact, and think, well, okay, we're going to see a bit of a hit to some of the trade numbers, and perhaps that will impact some of the other numbers. But we've got this inflation concern. That's the sort of longer term issue that we need to deal with the time frame that monetary policy operates on. So I don't think they're going to be knocked off course by that sort of consideration, unless things were to really get worse from here and to persist longer than they expect it to happen.
All right, fair enough. All right, let's move closer to home for you then, albeit not quite home. New Zealand, RBNZ, Reserve Bank of New Zealand. They'll be announcing later on, at least our time today anyway, your time tomorrow. I guess 50 basis points to what? Couple of percentage, 2% now is widely expected. Any chance of 75 basis points out of them?
I haven't heard that as one of the likely outcomes. That would be very aggressive, I think. They don't want to frighten the horses, I imagine. 50 basis points is still a pretty decent move, and
right.
Obviously that's what they did last month. So they are in a similar situation to obviously a lot of reserve banks. Inflation is well above where they want it to be, and they have to just scramble to get policy settings back to sort of more neutral levels. So I think 50 basis points at the time is a pretty good move, though, and so that's sort of where I expect them to land today. But clearly indicating also that they'll have more to do in the meetings ahead.
Okay, right. Let's move to your home territory and Australia. Election. Before we get on to the RBA, general election, new government. Obvious question. So what?
There'll be definitely differences, obviously, in their priorities, and we'll definitely see, in particular, I think a move to on climate policy. That's a clear point of difference between the new incoming Labor government the the previous centre-right government that's was in power for about 9 years now. So the Labor government has commitments to lower Australia's carbon emissions at a faster pace than has already been set under the the various international obligations. So we'll see how much success they have in doing that. That's probably the main point of difference. Also, probably going to be more, shall we say, fiscally expansive. If you looked at the policies that they took to the election relative to the defeated government, the estimates were that they'll increase the deficit by about 7.4 billion Australian dollars, if I remember correctly. So definitely a bit more aggressive on fiscal policy is likely going forward. And so probably the main question for us is what impact that has on the RBA. As we know, the RBA.
Yeah, let me ask you about the RBA. If I sound just interrupt. I mean, I know we talked on previous podcasts about whether or not, as they've been one of the more dovish of the the more major central banks, perhaps they've been behind the curve as well. Yeah. When we had the May tightening, we saw rates going up by 25 basis points, and only 15 basis points were expected. And from the minutes, they were suggesting perhaps there was even a case as much as 40 basis points. So in line with perhaps want to get onto my little spiel about the ECB, do you think there's been something of a fundamental shift in the economic scenario that the RBA is working with now?
Oh, definitely. They haven't come out and admitted that they got the inflation forecast wrong, but it's clear that it's a lot higher than they expected it to be, and it's persisting longer than they expected to. So, it was just a few months ago that they were saying, we won't need to tighten policy until 2024. So they've clearly, reassessed their views very sharply over the last few months. And, so now we're going to see, again, a pretty aggressive tightening cycle to get policy back to more neutral levels. So, I think at the last meeting they were talking about, is it going to be 15 or 40, or just because they're at an unusual level, 0.10, you normally move in 25 increments. Right. So I think there's just for neatness sake, they want to sort of get back to, a multiple of 25 and work from there. But that, I guess that's probably not the most relevant consideration when you are deciding how much to tighten. And so we'll see if they do sort of get back to that sort of increment going forward.
All right, fair enough. Last from me from your side. Let me just quickly ask you about Hong Kong. I know you discussed this on previous podcasts, but I always like to ask it when it comes up relevant. We had the Hong Kong Monetary Authority intervening to defend its dollar peg, middle of May for the first time since 2019 or so. To shore up the Hong Kong dollar. I mean, again, every now and again, when we start to see Federal Reserve raising interest rates, and particularly given some of the problems that Hong Kong as a financial centre has been going through over the last couple of years or so, is there still any kind of belief that we could actually see that peg being broken, or is it really just speculators every now and again think, well, this is an opportunity just to have a look at it?
Yeah, I mean, I used to live in Hong Kong, and I was there for several years, and it's a perennial topic that comes up whenever there's a big shift in Fed policy. Is this still the right thing for Hong Kong? And you can always imagine scenarios where what the Fed is doing, and by implication what is happening to Hong Kong monetary policy because of the peg is not the best outcome for Hong Kong's current conditions. But there has just never been, well, I won't say never, but there's rarely been any sizable I think momentum behind a move to end that peg. At one day that might happen, and they'll just sort of link to the yuan, but it'll be a surprise when it does happen, probably. And it's not. It's hard to see it being on the cards right now. But obviously, with the Fed moving to an aggressive tightening cycle, it becomes a topic of conversation.
Yeah, guess something to keep an eye on. Okay, thanks. Anything from your side, Brian?
I should say. As I was just saying probably just about the RBA. Again, what has changed with a new government coming in? I don't think it's going to change, obviously, the direction of what the RBA is doing. They're clearly moving to increase rates going forward, but you might see a bit of partisan sort of discussion about whether the new government is going to mean that the RBA has to move more aggressively than what they would have under the previous government. So I think your view on that might just reflect your views about politics rather than being clearly right. Based on the economic numbers. But that will be an issue whether the RBA feels that it needs to raise rates higher and more quickly than what they would have under the previous government. But obviously, it's a counterfactual that we will never really know.
Okay, brilliant. Thanks for that, Brian. Right, across to Europe then to round off this podcast. Well, I guess over here then it's still very much a focus on what's going on with the war in Ukraine. And at least so far in terms of economic data, it still seems to be largely confined to prices. If you believe in the PMI data, I must say surveys as far as Europe's concerned haven't been too well correlated with the actual GDP numbers of late. The May flash index found only a relatively modest deceleration in economic activity, and even then to still a historically high rate. That said, so it did overestimate first quarter GDP, so we need to treat these things with care. But what is clear, though, is that prices are still very much being buoyed by what's happening to Russian supply cutbacks, particularly with regards to energy. The new NATO applicant, Finland, last weekend, they became the third European country after Poland and Bulgaria to find the Russian gas taps being turned off. And that's making it all the harder to try to get inflation back down anywhere close to the target. And crucially, at long last, it seems that was also that view is kind of being accepted by the majority of the European Central Bank's Governing Council. At long last, they seem to be singing from pretty well the same hymn sheet, at least in terms of the direction of interest rates anyway. And a 25 basis point hike from the ECB in July now looks to be pretty well nailed on. Next meeting is on June the 9th. That's probably still too early for a hike in rates because they need to get through their forward guidance on quantitative easing first, and that's not due to be completed until the beginning of the third quarter. But it does look increasingly as if we will see rates going up in July. And indeed, there's calls from some central bank governors within the Governing Council, I should say, for an increase as much as 50 basis points. I think that's probably unlikely at this stage because there's still very much a concern about just how much damage that this war in Ukraine and the zero COVID policy and the like in China might have on the Eurozone economy. And a number of doves are still cautious about raising interest rates too rapidly, but nonetheless, at long last, it does seem that we'll see rates in the Eurozone going up. That said, I think some of the comments coming out of the ECB have certainly helped the euro over the course of the last couple of days or so, and appear to have put something of a block in the path of what's becoming a fairly strong positive trend for the US dollar. But although it's temporarily stopped it, I've got to think so long as we see the Fed raising interest rates aggressively, as Terry was talking about, then ECB are still going to be lagging a long way behind. And there's still at least a reasonable chance, I suspect, that we could see euro dollar hitting parity at some point. In terms of the actual data themselves, well, there's not too many surprises really. Econoday's ECDI index has been moving fairly close to zero for quite a long while now, essentially indicating that most of the bigger economic data have been coming in, at least broadly in line with expectations. And in a nutshell, that really means that growth, although it's doing okay, is certainly very much slowing, whereas inflation continues to rise very quickly. Inflation across the Eurozone now moving pretty well every month now at a new all-time high. We're currently running at 4.7%, sorry, 7.4%, so some 5.4 percentage points above the ECB's target level, and every chance we'll see that moving up over the course of the next month or so as these higher gas prices come through. Indeed, there's still all sorts of problems at the moment in terms of the various sanctions that the European Union is trying to implement on Russia, with disagreements coming out of some of the eastern bloc of the country, of the region, notably like to Hungary, about whether or not full sanctions should be, in terms of embargoes, should be implemented on Russia. And that's just adding to a general sense of uncertainty about what's going to happen to energy prices across the region as a whole. But nonetheless, the bottom line is that growth is slowing, albeit not necessarily so far rapidly, but inflation continues to go up. So as much as we've seen across across the rest of the world, inflationary pressures in the Eurozone on the way up, perhaps more so than some countries, simply due to what's happening in the locality of Ukraine. And it does seem that rates now out of the ECB will be higher in July and probably, I suspect, tightened again before the end of the year. What else have we got coming out of the UK? Numbers here really been quite mixed, and it's quite hard to work out exactly where the UK stands at the moment. The recent hard data have some bits of strength, some bits of relative weakness. It's also true of the surveys as well. Obviously, it's still a case of looking at numbers, trying to work out exactly how much an impact the Ukraine war is having in terms of economic developments, and there's still ultimately a relative shortage of the hard data to give a firm impression. But what surveys we have had from the likes of the Confederation of British Industry, which are normally fairly reliable, suggests that manufacturing and indeed the consumer side are actually holding up relatively well. But the flash PMI we had for May out this morning, that showed its fourth steepest decline on record. On the composite output index there was down just 51.8. That's only just less than 2 points above the 50 expansion threshold. So it really would, taken at face value, suggest there's been a very sharp deceleration in economic activity in the middle of the quarter. Does that matter for the Bank of England? Well, we've now got inflation in the UK running at 9%. That was up fully 2 percentage points. This is the April number. That was up fully 2 percentage points from what we had in March. The core rate's up at 6.2%. So we're talking record numbers here. And there's every chance now with what looks likely to happen to the price cap they have on energy bills over here. That will be reviewed in October. And from what the data is suggesting at the moment, that's going to go up about 40% or so once we get into the fourth quarter. So there's every chance we're going to see double-digit UK inflation before the end of the year. So for the Bank of England, it still seems likely that we got further interest rate hikes to come. I suspect it's still going to be 25 basis points once we get into the next meeting on June the 16th. There's certainly some people who will still be pressing for a 50 basis point hike. But when you look at around some of the other surveys, I mean, the likes of the consumer sector, although the CBI suggested that retail sales are holding up, GfK Consumer Confidence Index, that's plummeted to a record low in May, suggesting that perhaps we are more and more now starting to see the impact of higher prices, squeezing household budgets, higher interest rates doing the same sort of thing, starting to knock consumer spending. And it wouldn't surprise me at all if we do see a relatively weak second quarter. Bank of England knows expecting no growth in the second quarter anyway. So I guess bottom line is, as we've seen across much of a lot of the world at the moment, is growth continues to slow. But really, until we see inflation being squeezed out of the system, interest rates can still be expected to be hiked over the course of at least the rest of this year, if not into next year as well. I'll mention before I finish on my side, Switzerland as well. A little while ago, it looked very likely that we're going to see the euro-Swiss franc cross rate moving down to parity. And comments coming out of various ECB members over the course of the last few days, really telling the market, well, look, we're going to hike interest rates in July. That's provided the euro a little bit of a fillip, and so it's taken some of the pressure off the SNB to continue with what has been in partly aggressive intervention over the last few weeks. But the bottom line, I think, for the SNB is that they're running with a minus 0.75% policy rate, its benchmark rate, and it's been there for a long time now, and the Swiss central bank really doesn't like having interest rates so negative. So were we to see, as seems increasingly likely, the European Central Bank come out and raise interest rates in July, expect the Swiss National Bank to not be too far behind. It only meets quarterly, so chances are they'll be waiting until their September meeting before they do anything. But if rates go up for the Eurozone in July, expect the Swiss National Bank to follow by probably the same amount once they get into their September meeting. Okay, I think that's probably it from my side. So before we wrap it up, has anybody else got anything else they'd like to say before we finish? Deep breath.
No.
Good. Yeah.
So it's all inflation and policy tightening, but except for China, basically.
Yeah. Yeah, okay. I think that probably just about summed it up, really. It's interesting. It's got to be said. I mean, the fact that you've still got a couple of outliers from Asia, the likes of the Bank of Japan and the People's Bank of China, whereby rates essentially are still either flat or going down there, and in the rest of the world they're pretty well going up or they're about to go up, and that has to put some kind of strains, I think, in terms of what's going to happen in the foreign exchange markets, and indeed in some cases, particularly with dollar rates going up so sharply, what's going to happen to liquidity conditions around the world, which has all sorts of implications of itself. Right, okay then. Well, let's wrap it up. And as far as today's concerned, then I guess only time will tell if it's could be possible to bring inflation back under control while still avoiding a recession. In fact, if inflation keeps on rising, some kind of downturn is very likely anyway, irrespective of what the central banks might do with interest rates. In any event, what happens to prices over the next few months will be crucial to policy and the economic outlook. So make sure you're up to date with all the major economic statistics, policy moves, and other key market moving events in Econoday's global economic talent calendar. Martha Terry, Max Spran, and myself, thanks as always for listening. We hope to see you again next time. Bye for now.